This is Nightly Business Report with Bill Griffith and Sue Herrera.
Piece of the puzzle. Federal Reserve policymakers acknowledge that inflation pressures are building, and investors aren't quite sure what to make of that.
Icon in limbo. Why Xerox finds itself at a crossroads with a future full of question marks.
For sale, why some are spending tens of millions of dollars on big empty spaces with absolutely nothing inside. Those stories and more tonight on Nightly Business Report for Wednesday, May 2nd.
And we do bid you good evening, everybody. It was a day that should have been good for the bulls. The Federal Reserve, after all, said what many wanted to hear. It kept interest rates steady and hinted that more rate hikes are likely later this year if the economy continues to strengthen. Policymakers also acknowledged that inflation was ticking higher, but said that it did not expect prices to spiral out of control. Stocks did initially rise on those comments, but then a slow, steady decline took hold into the closing bell this afternoon. The Dow finished down 174 points to 23,924. The Nasdaq was off by 29. The S&P fell by 19. Steve Leisman has more on today's Fed decision.
The Federal Reserve keeping interest rates unchanged at its May meeting and signaling further rate hikes in the months ahead, but it did not, as some feared, suggest any quicker pace for those rate hikes. It also acknowledged that inflation had moved up towards its 2% target, but again, didn't seem especially concerned about it. In fact, it went out of its way to remind investors that the 2% inflation target is quote-unquote symmetric, mentioning that twice in the statement. So what does symmetric mean? Well, it's kind of seen as a code word to markets that because inflation ran so long below the 2% target, the Fed is not going to quicken the pace of hikes if, for a time at least, inflation runs above that target. So the result of the statement was that markets raised the probability of a 25 basis point rate hike at the June meeting to a near certain 97%. It kept unchanged at a pretty high 68% probability the chance of another hike in September. And it lowered a bit to 35% from 39% the probability of a rate hike in December because the Fed didn't seem so clear about that third hike. Now markets are less clear, and some bond yields, by the way, fell as well. On the economy, the Federal Reserve said very much what it had said in its last meeting, that economic activity is rising moderately, that job gains are strong, the unemployment rate is low, and that business investment is growing strongly. Household spending was seen to be moderated, and the risks appear ultimately between lower growth and higher growth to be, quote, roughly balanced. So is it 2 or 3 more rate hikes from here? Well, it's definitely 1 more according to markets, and probably 2 more. And the Fed and investors and markets and everyone now has 7 more months of unemployment, inflation, and growth data to figure out if it's 3 more. For Nightly Business Report, I'm Steve Leisman in Washington.
And as the Fed watches the labor market, a new report shows that it remains strong. According to the payroll processor ADP, private companies added 204,000 jobs in April. That was above expectations and the 5th straight month that gains exceeded 200,000. The growth was broad-based as well, coming from the service sector and also industries like construction.
But trade issues continue to hang over our economy. Amid the threat of additional tariffs, a U.S. delegation is now headed to China for talks on how the world's 2 largest economies can avoid a trade war. Eunice Yoon is in Beijing for us tonight.
In just a few hours, President Trump's entire economic team, led by Treasury Secretary Steve Mnuchin, will be arriving in China. They're expected to go immediately into talks, which will begin on Thursday local time and last until Friday. Secretary Mnuchin and his team are scheduled to see President Xi Jinping's top economic advisor, Liu He, and there are reports, unconfirmed by the government, that they could also meet with the vice president and possibly even President Xi himself. Any result of the negotiations would likely be announced on Friday afternoon. I spoke with a Chinese official who's been involved with trade negotiations here in the past, and he said that this time round, there haven't been the same level of preliminary meetings to lay the groundwork for the higher level negotiations as there have been in the past. So the whole process is being handled much differently by the Trump administration. Ahead of the discussions, the Chinese are sending mixed signals. On the one hand, they're painting themselves as the champions of free trade and taking steps to be open. On the other hand, today, the state press is taking a hard line, suggesting China won't be able to budge on its industrial policies or lop $100 billion off its trade surplus with the U.S. The foreign ministry said that the talks could be constructive as long as the U.S. side was sincere. So it's difficult to know what the Chinese will be willing to offer and whether or not that's going to be enough to satisfy Secretary Mnuchin and his team. For Nightly Business Report, I'm Eunice Yoon in Beijing.
And Tesla is trying to make inroads into the Chinese auto market, as we reported last week. Tonight, investors got a look at the electric car company's financials, and the results were not as bad as some had feared. Tesla's loss narrowed to $3.35 a share. Its revenue rose from a year ago to more than $3.4 billion. As for the stock, it was volatile in after-hours trading. Phil LeBeau has the one key takeaway from Tesla's quarter.
A big sigh of relief for Tesla investors as the automaker reported better than expected results for the first quarter. It still lost a lot of money, $3.35 a share, but that beat the estimate by about 20 cents a share. Revenue coming in better than expected. The one takeaway from this earnings report, Model 3 production. It was at 2,270 per week for each week in April. And the company says it's also on track to hit its target of building 5,000 Model 3s per week within a couple of months. And remember, the original target was to hit 5,000 per week by the end of June. So again, Tesla shareholders a bit of relief as the company reported better than expected results and gave some fairly encouraging news in terms of its outlook for its newest vehicle, the Model 3. Phil LeBeau, Nightly Business Report, Chicago.
And from a modern company to one that's more than a century old, that would be Xerox. The iconic American brand finds itself at a crossroads tonight. There are reports that private equity firm Apollo Global Management is interested in buying it. Apollo's interest came to light today after Xerox's CEO stepped down amid pressure from activist investors Carl Icahn and Darwin Deason. And the CEO's departure also puts its merger with Fujifilm, which many viewed as a lifeline, in jeopardy. It's just the latest twist in Xerox's long and storied journey. Founded in Rochester, New York in 1906, the Haloid Photographic Company originally made photo paper and equipment. Some 30 years later, physicist Chester Carlson invented a process for transferring images using static electricity, dubbed xerography. After being turned down by the likes of RCA, Kodak, and General Electric, Carlson sold his patents to Haloid in 1949. A decade later, the copier industry was born with the release of the Xerox 914, and the rest is history. The company hit the New York Stock Exchange in 1961 under the name Xerox, a name that became synonymous with the office copier. And for years, it dominated the space, growing into a Fortune 500 company. But then things changed. In the 1980s, Xerox was slow to adapt to the coming digital age, instead choosing to diversify into financial services and other areas. The company began losing market share in its core business, and by the beginning of the 21st century, its stock collapsed. Things turned around in the 2000s when the company began focusing on services instead of products. But that didn't last long. Amid declining revenue and pressure from Carl Icahn, Xerox spun off its business services company ACS in 2016. Today, that company, now called Conduent, runs food stamp networks for nearly half the country, among other things. Earlier this year, Fujifilm, which has had ties to Xerox since the early 1960s, bought a controlling stake in the company, a sore spot for some investors, which has brought us to today's events, leaving an American icon in limbo.
So let's turn now to David Benoit for more discussion on Xerox. He's a reporter with the Wall Street Journal, and he covered this story. David, welcome. It's great to have you with us.
Thanks for having me.
This is a very tangled web, this story, needless to say. And it comes down to accusations that the heads of the company, the CEO and others, did this Fuji deal without the consent of the board or the support of the board to save their own jobs.
Right, exactly. So what essentially happened was last year, Carl Icahn was had a representative on the board of Fuji. on the board of Xerox, even I'm getting tangled. And Xerox essentially debated about whether or not to fire their CEO, Jeff Jacobson. And in November, they told him, hey, you need to stop these conversations you've been having with Fuji. We might replace you imminently. And instead, he went on and did it. He had a little bit of a blessing from the chairman and the lead independent director, but he went and kind of rushed to get the deal, is how the Icon team describes it. And a judge last week agreed with them and blocked the deal from happening.
Clearly, somebody sees value in this company, though, whether it's Carl Icahn or Darwin Deason or now Apollo Management. What are the strengths that Xerox has right now?
So the argument for why Xerox is an attractive asset is one, they have a ton of patents. What you guys just showed shows, right, they've had a long history of major inventions in America. They have a lot of research. They have a lot of technology at their fingertips, and there's new realms for them to get into. There's 3D printing. There's kind of new types of printing on like fruit and other topics that really they could be a huge asset if they're run right and if they're given the ability to innovate.
So what happens next? As I understand, the judge would have to approve any deal with Fuji. And where does this leave Fuji?
Sure. So what happens next is, one, the Icahn and Deason and Xerox settled their legal fight last night, and the CEO of Xerox is out. Icon's CEO pick is in, and essentially he and Deason are more or less taking over the board. The judge has to approve that settlement. That could come any moment, really. Fuji is trying to block that settlement because essentially the new board of Xerox under Icahn and Deason are already saying, hey, we're gonna step back. We might not finish this deal. We want to look at other options. We want to figure out what to do. And Fuji's going to try to hang on to it, but their shareholders weren't too pleased today at the idea they might pay more. So who knows what happens next?
Who knows? And I know investors are going to be watching it closely and reading your stories about it. David, thank you very much.
Thanks
David Benoit with the Wall Street Journal. Bill?
Still ahead, should shareholders be happy if their company goes out and gets a high-profile executive from another firm? Or is it a case of buyer beware?
Cambridge Analytica is shutting down and will declare bankruptcy in the U.S. and the U.K. That decision follows the disclosure that the political consultancy firm misused Facebook data. The firm has been losing clients and has faced rising legal fees in the wake of that data scandal.
It is every investor's worst nightmare, financial fraud. And even though law enforcement agencies have more tools and laws to help police it, the system is still far from perfect. And today it was the topic of a conference in New York City attended by our Scott Cohn, who has covered all manner of fraud over the years, and he joins us tonight to talk about this. This tends to come in waves, so how can investors tell when there's a new wave of fraud on the horizon? Did you talk about that today?
Well, yes, and I guess there is a wave coming. That's for sure, according to people that were at this conference. This was a conference that was put on by the University of California, Berkeley's Center for Business and Law. So it was really a cross-section of regulators, attorneys, law students, investors, journalists. So a lot of interesting takes on this. And it's not just because we're at that stage in the market or because these things do happen in waves, but because of basic human nature. These frauds tend to build on each other. We have the S&L scandal, the accounting frauds of the early 2000s, the housing crisis and the mortgage crisis after that. All variations on very similar themes, and that means, sure as it happened before, it's going to happen again.
So what did you discuss at all, Scott? What areas or industries or sectors are more vulnerable than others?
Yeah, and of course, as Warren Buffett famously said, you don't know who's been swimming naked till the tide goes out, and we're not at that point yet. But a couple of areas that were touched upon. The big short seller, Jim Chanos, is looking closely at healthcare. A fifth of the economy, a lot of things going on there, a lot of transactions that he's looking at, dialysis companies, private companies buying up medical practices, things like that, that he says could lend themselves to creative accounting. There was also a whole panel on cryptocurrencies, which everyone is talking about, and everyone seems to agree they're here to stay. But the issue right now is all of these initial coin offerings, all the new things that are coming up. The SEC Assistant Director of Enforcement, who's in charge of the Commission's working group on this, Valerie Stepanek, said that they're looking at it very closely at whether these coin offerings are securities, which is a company raising money, or an actual coin offering starting up the currency. She's worried, and so are a lot of others at this conference, that a lot of people are going to lose some money on this.
All right, Scott, well, we're glad you're on the job, keeping an eye out for this next wave. Thanks for joining us tonight. Scott Cohn in New York City.
Pizza Hut and KFC failed to deliver for Yum Brands. That's where we begin tonight's Market Focus. A key measure of sales at established Pizza Hut and KFC restaurants rose less than expected in the face of rising competition in the fast food industry. And that overshadowed better than expected earnings and revenue at the parent company, which is Yum Brands. Shares dropped 7% to $80.20. Humana reported better than expected earnings and revenue in the most recent quarter and raised its full-year profit forecast. But investors focused on higher than expected medical costs in its Medicare Advantage business, which is an important growth area for insurers. That sent shares lower by 2.5% to $287.67. CVS Health topped quarterly profit forecasts thanks to higher sales of prescription drugs and a lower tax rate. The company still expects to close the $69 billion deal to buy Aetna in the second half of the year. But on this down day on Wall Street, shares still fell 3% to $65.94.
Consumers are once again charging more on their credit cards, and that helped MasterCard report higher than expected sales and profits today. The company also benefited from more people using their cards outside the country that they're issued in, resulting in a rise of more than 20% in those lucrative cross-border fees. MasterCard was up 3% today to $185.82. Wayfair posted a slightly wider than expected loss, but revenue did grow nearly 50% as the retailer attracted more customers to its website. In fact, the CEO said the company is gaining market share in the home goods e-commerce market. Investors seem to like that news, sending the shares higher by more than 13% today to $74.07. And AIG reported earnings that missed estimates. The global insurance company posted a 21% decline in net income, citing continued struggles with its property casualty insurance business. Shares of AIG traded initially lower in after-hours trading tonight.
One of the largest department stores in the world is thinking small. Macy's acquired a boutique retail shop in New York, but it might not be the store that Macy's is after, but rather the woman behind it. Courtney Reagan explains.
Macy's went shopping and bought a 7-year-old New York store called Story. Story describes itself as a living magazine. It completely changes its inventory and presentation every 4 to 8 weeks to fit a theme, which aligns with the message of a corporate sponsor. Like its feel-good story with health insurer Cigna that sold products that, well, helped consumers feel good. Key to Macy's acquisition of Story is founder Rachel Sheckman. She'll stay involved with Story and take on a newly created role of Macy's Brand Experience Officer, where she'll focus on what she does best, innovating the in-store shopping experience. Former brand consultant for companies like Kraft and Tom's Shoes, Sheckman has caught the attention of many retail CEOs for the creative way she executes physical retail, though she's never scaled her ideas beyond the single New York City location. The move makes Macy's a part of a growing trend of retailers buying innovative companies for both the concept and the talent that comes with it. One example is Walmart, which spent more than $3 billion to buy Jet.com, and founder Mark Lowry. Lowry has since bought smaller e-commerce companies for Walmart, like Bonobos and Moose Jaw, for both the underlying business and the expertise of the employees. For Nightly Business Report, I'm Courtney Reagan.
And Macy's isn't the only company that goes after superstar executives. Other retail giants in the past, like Sears and JCPenney, have also brought in star power to help turn their struggling stores around with very mixed results. Is this the best way to go for shareholders? Joining us tonight, Eric Gordon is a professor at the University of Michigan's Ross School of Business. Good to see you, Eric. Thanks for joining us tonight.
Hello, Bill.
And it's not just about retail. You pick any industry. Maybe the most famous instance of a company hiring a superstar executive was years ago when Chrysler hired that hotshot Ford executive in Lee Iacocca, right?
Yeah, and that one worked. But you know, if you're an investor, you have to have mixed feelings. You're excited, but you have to be worried because sometimes it works really well, sometimes it works for a little while, and sometimes it doesn't work at all.
And is that industry specific? I mean, does it work better in retail, as Bill mentioned, or retail in terms of auto industry, and not in other areas?
You know, it should work in retail because retail is an area of creativity. An individual should be able to make a big difference. Arthur Martinez made a difference for a while at Sears. He brought a lot of creativity, a lot of star power from Saks. But if you look at J.C. Penney's, where they brought in Ron Johnson, a star from a star company, Apple, that one completely failed. But there are industries where I just don't think you have stars or star power. It doesn't make sense. It's blocking and tackling, and you just want an experienced person. But, you know, in some industries, like retailing, it works half the time, and half the time it doesn't.
What's the message for investors, a lesson of some kind, when a company does go out and hires a superstar executive? Can you guess ahead of time whether it's going to work, or do you wait to see what the results are going to be?
You know, I think you can make some guesses. So Ron Johnson had never been CEO of a company. He had never done a turnaround. So Penny's needed a CEO, and they needed turnaround experience. So he didn't have the experience. With Rachel, the big question will be, can she do things that scale at Macy's? She's done a fabulous job at her store, but what happens when you have a lot of stores?
What about the cultural aspect of a company? I mean, you look at some companies, you take a Starbucks, for instance, or an Apple, or there's a specific culture that surrounds and is in that company. Does it matter what kind of a CEO you bring in? Does it have to match with the culture, or can he change the culture?
Oh, Sue, you nailed it. There's got to be a match. Ron Johnson and Penny's were a complete mismatch. He was California. He was so California he didn't want to move to Texas to Penny's headquarters.
Right.
Penny's old guard just rejected him like, you know, an immune system rejects antibodies. So making that fit from small to big, from what you were doing to a new one, you know, you can't make a big contribution at a big company if you can't get a lot of people on board with you.
Indeed. Eric Gordon with the University of Michigan's Ross School of Business. That was fun. Thanks, Eric, for joining us tonight.
My pleasure.
Coming up, the sweet life.
Call it deconstructing luxury. We'll take you to a $58 million West Hollywood penthouse and show you nothing. I'll explain why coming up on Nightly Business Report.
UPS may one day deliver bulky goods. According to Reuters, the delivery company is in talks now with at least one trucking firm to launch an in-home delivery service for large, heavy items like sofas. Analysts say that the move would give UPS an advantage in the so-called final mile delivery. That's a market that's expected to grow to about $12 billion over the next decade. And that sends shares of trucking companies like Werner Schneider and Ryder higher in today's session.
As interest rates rise, applications for new mortgages and refinancings are falling. Last week, mortgage applications were down more than 1.5%, and it comes as rates on some 30-year fixed-rate home loans reach their highest levels in more than 4.5 years.
Imagine paying tens of millions of dollars for a home that has absolutely nothing in it, not even the kitchen sink. Turns out it's the latest trend in multi-million-dollar real estate. Call it deconstructing luxury. Diana Olick is in West Hollywood, California for us tonight.
This $58 million West Hollywood penthouse condo is not tricked out.
It's stripped out, right to the concrete bones.
This is amazing. This is definitely one of a kind.
It's a new strategy getting big play among ultra high-end sellers, especially in New York and LA.
People love mid-century, but they want mid-century today.
Real estate agents call it white boxing.
White boxing is really just having a blank canvas. So you can walk in, you just see the walls, you see the interior space, but you can do whatever you want to that space.
So rather than flaunting a chef's kitchen or spa bathroom, the seller boasts basically nothing. It seems as if the property is new. Although this storied penthouse is anything but, its views are unmatchable because zoning now prohibits towers here this tall. Since opening in 1966, it has housed celebrity residents from Cher to Joan Collins, Elton John to Lindsay Lohan. Clearly, it's a one-of-a-kind space in a one-of-a-kind building, so any buyer is going to want to make it one of his or her own kind. Better to be architect and designer ready than move-in ready.
For us to take a white box and design like this is much easier. First of all, if you can get to bring the client here and they get to feel and breathe the space, a property is definitely more valuable stripped out.
Architect Gavin Broden came up with some potential designs for the 7,000 square foot space so potential buyers have something to look at other than the view. Have you ever gone into a beautifully high-end home and had the buyer come in and say, I want to take it all out?
That happens to us on 9 out of 10 projects.
At this price, a property is not perfect until it's personal. For Nightly Business Report, I'm Diana Olick in West Hollywood.
And before we go, one last look at the day's numbers on Wall Street. The Dow dropped 174 points to 23,924. The Nasdaq was off 29, and the S&P 500 fell 19. And that will do it for us tonight on NBR. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.